transaction, it is for a fixed period. It is between two known parties, two counterparties, bank and you, identified, and it is for a specific period. Is that right? 1 year. Is there a problem? Very simple, no? Is there a problem?
The bank doesn't get that much of money out of my money.
Yeah, but then the banks are large institutions, very big balance sheet. Some of the most sturdy balance sheets you will see in the system are the banks. Very rare for a bank to fail. You know, it's all very nice to look at default and all of that, on and all, big dues and all. Everybody will say breaking news. These days they say for everything. But anyway, but it happens very rarely. You know, the whole country was going to fail, everybody stopped it. You know? So default is a very rare thing. You know, however romantic it may sound, default is a very rare thing. Correct? So banks have sturdy balance sheets. Unless you are giving it to some, you know, XYZ Bank Limited, which has come at the corner of your shop with this, lane. Big banks, you can be sure that, they will be fine. They are safe, as you said. Understand need-based markets. Is that right? So what we are saying, why are we taking a deposit today? We have some safe. Is that right? Need-based markets are extremely rigid. So what if you wanted the money later, after 1 month? Bank will say, break the deposit and take today's rate, or it will say take a loan against it. Is that right? So you can only transact if two parties know one another. You can only transact if the time period matches. You can only transact if the interest rate is agreeable to both. Is that right? What is the other market? The bigger market is what we call as a view-based market. What is this view-based market? Why am I lending today? Why am I giving my money to the bank today? Because I think the interest rate tomorrow will be lower. You get it? Why am I borrowing today? I am borrowing today because I need money. But I am borrowing money today because I think tomorrow the interest rate will become higher. Is that right? So, when you say financial market, a financial market is not constructed by just needs. Okay? We say, stock market is constructed by people who can come and sell their shares. Imagine a situation where you buy some shares and you go and you have to search for somebody else who wants the same number of shares for the same price. The market will be completely illegal. Is that right? So when we say market, the characteristic of the market is that it should be, this rigidity should go, which means you should be able to borrow for any number of days at whatever is the prevailing market price. So instead of this FD, you just convert this FD into a market instrument. What is the market instrument? A certificate of deposit. What is that? It is a security. Correct? What is a certificate of deposit? You buy it when you have money. Correct? Whenever you need money, what can you do? You can go and sell it in the market. So you don't have to hold it for 1 year. You can hold a 1 year's certificate of deposit, can be held by 365 people 1 day at a time. What is the interest each one will get? Depending on what price they bought and sold. Is that right? So the interest rate in the market has gone up. What will happen to the CD? Its value will fall because it's only paying 8%, right? So its value will fall. If the interest rates in the markets go down, the CD will become very valuable because market may you're only getting 6, whereas the CD is giving you 8. Its value will go up. So the price will keep changing depending on where the current market is, and whoever reaches the CD to the bank on the maturity date will get the. Is that right? So that's your market. So what happens in the market? Anyone can hold at any point of time and can buy at any price at that point in time and hold for whatever time period, and whoever returns it on maturity date is able to get the money. Is that right? So it is a. Okay. So what you have really is. So what happens therefore? You have from a need-based exchange between I have money, you want money, the interest rate is 8% and for 1 year. Instead of doing that, what we do is we have an extremely flexible situation in which it's democratic. Anyone having any amount of money can access the market. Is that right? And what are the markets that are available? I told you right from the morning there are 3 things which we said, which is what? There is liquid requirement, there is income requirement, and there is growth. There are three markets. There is a market for liquidity, there is a market for income, there is a market for growth. So what is your asset allocation? How much money will go where? That's all. And what will that depend on? Which market is doing very well today? You tell me. So all your money should be in. So the first rule in asset allocation is be aware that there is a market and there is a market price. You should get that. You should get it at the lowest possible cost. There is a market out there. You don't have to be shortchanged with 3% or 4%. You can ask to be taken to that market, right? And you can go to that market. And you can lend in that market and you can get the market price. The bank is convenience and there is a high level of familiarity, right? So there are people who tell me that, PSU tax-free bonds have come. So I should be investing in them. For a long period, I will be locked into a rate of 7%. What do you think? They'll come down. Or have they been already announced? They've been announced the budget, but the current thing has not come. Right? So what do you think? So there is a PSU government entity which is issuing a bond. It says 7.5% tax-free. What should you do? We are in asset allocation decision, right? So you should tell me. What is the first question you will ask? Balance sheet, sir. First question. Where is my money going? Why should it go here? So you look at the PSUs. The minimum that you should do is what? Is that balance sheet generating a surplus? Is it a profit-making PSU? Is it making profit? Am I confident it will continue to make profit? Correct? 2. How much has it borrowed already? What is the surplus? Has it borrowed a lot already? Does it have enough money? Does it have enough assets to pay the money? Correct? If these two conditions are true, and what is the only question you want to ask? 10 years, people are saying 10 years I'll get 7%. 10 years the PSU has to be there, right? Am I taking a risk? No, government backed, yes. HMT also was government backed. So my cousin was working for a woman. Government backed it was. Only those businesses, there are no gods in the market, unfortunately. Democratic place. Creative destruction. Businesses that do not know how to use their money will die. No one can protect. Invest. So if there is a good business, so what would you do? How would you know it's good, bad, ugly? Yeah? So democratic access, I said. So what happens then? So PSU banks come in, bonds come in and you bought them. Your friends bought them, you also bought them. What happens next? See, just like how we are saying, don't have a bravado that it will not fail. Don't have the view that it will fail, correct? The reality is, we don't know. It can be this or that or something anywhere in the middle. Not somewhere in the middle, anywhere in the middle. What do you do? You tell me what you do. Should not buy. We can't say, right? We invest today. We don't know.
Make an informed choice.
How? That is the reason why you should track. If you are investing in the markets, correct? There are only two realities for you. What are those two realities? The price of what you have bought will reflect what is happening now. Correct? Why have people stopped buying houses? You tell me. We all have been screaming for all the years we can remember, don't buy houses. Correct? Everybody, you talk to anybody who talks on personal finance, they will say don't buy houses. Yeah, because it's a very solid, big investment and a lot of money gets locked in. People have finally stopped buying houses. Why? Those who bought are not able to sell. Is that right? So the market price is a very good indicator of whether there are buyers or not. If there are no buyers, whether the builder brings the price down or not, you are not able to sell the house you bought, even at the price at which you bought. What do you know? You know that there is no new buyer coming in at that price. Is that right? Track that price. So if you are investing in the market, that market must have a price which you should be able to track. Is that right? One. What is the second thing? Two conditions I said. One, an updated price. Updated. This is what is information disclosure. Dynamic disclosure of information which tells you what is it worth today. I have always had this argument, just like the Sensex. If we had a real estate index, And every day we told people, the house you bought now, it is worth this much today, it is worth this much today. People will stop buying property. The biggest limitation of the property market is this, that it's daily indices. It's a highly manipulated market, right? It's not a very clean market. So all the more reason. Yeah, it's not a very clean market, so you don't get those prices on an everyday basis. But otherwise, you should know the price. And what is the second condition? You should be able to quit risk management. So you buy a PSU bond today if you believe it is a good PSU, it is doing very well. BHEL is a very good company. I mean, they are one of the world's renowned manufacturers of heavy engineering equipment. No one can do electrical equipment like them. So I am buying. Absolutely fine. Please buy. What should you be looking at? Look at not whether your interest is coming or not. The default will happen last, no? The company will continue to pay you interest till such time. What do you do when you don't have income and you have a housing loan outstanding? What do? You do anything to ensure that the EMI is paid. Is that right? So don't go by the interest payment. What will you be tracking? Price of that bond, correct? And price of the balance sheet, which is what? Equity. If something is going wrong with the company, which will fall first? Equity share price will start falling. Is that right? So when you find that its earnings are falling or when its equity prices are falling, you know that the risk has become higher than what it was when you bought. Is that right? What is risk management? What should you do? Quit. There is absolutely no reason for you to hold something which is not working. I tell this to investor classes again and again and again. There are people who are saying, oh, Satyam, has fallen so much, so should we buy now? I'm saying, why will you buy a company where the promoter has taken 8,000 crores and cheated? Is there no other shares to buy? We all like the bravado of catching a falling knife, Oh, this is very good value buy. There are 1,000 other companies with good managements, good profits. We won't look at any of them. Madam, has Suzlon turned around? These are common questions. Equity, the moment I talk about equity, you think DLF has fallen enough? I will show you the numbers for DLF. There's no reason to believe the company will turn around. A miracle is required for the company to turn around. Correct? So, I'm not saying you should learn finance. We'll do that in the afternoon. But it is important to develop that skill of asking, is this good quality or bad? Right? My illiterate grandmother would shake a coconut from outside and say whether it is good or bad. Are we not better than that? When it comes to our money, basic check, is it doing well or not doing well? Is it good or bad? That question we have to ask and be able to quit. Then we are fine. Then we are ready to go to market. You had a question. Yeah.
When we say falling, over what period do you consider falling gradually?
Oh, it can. The markets are subject to cycles, it will happen. Anything which is good, the prices will keep going up and down. But the falling will happen when the earnings are dropping, right? So you need to ask, what are the peers doing and is this doing worse? See, because it's your money, correct? You're looking at where your money should be at this point in time. That decision is always relative, isn't it? So, if market as a whole is going up, there are people who ask me this question even today. Madam, I bought Reliance Power IPO, Any hope is there? Why are you still holding? Because what was your hope? That you will buy at an IPO and sell at a profit where it lists, correct? That is the expectation. It did not list at a profit, correct? So what was the point of selling that? When it did not do what you expected it to do, correct? But what happens? We never sell at a loss. We never sell at a loss. Those are behavioral problems. We are always wanting to be right. What happens when we have a choice is this, that we don't apply simple principles of quality. What we are doing, we always want to be right. Our eagerness to be right is so high. So, Sheena Iyengar is an expert on the theory of choice. Her work demonstrates that higher and higher the choice, greater and greater the inability to make a choice. Why? She did a very simple experiment, very, very simple and profound experiment. She placed 35 jars of jams for tasting and said, anybody who tastes these jars will get a $1 coupon discount when you buy a jam. Correct? So for some time this was run. You think people went and tasted the jam? Yes. A large percentage of people who visited the mall were attracted by this offer of 35 jams being available to taste, and they went and tasted it. Sometime later, she just kept 4 jars. A very small, same offer. Small percentage of people went and actually tasted the jams. But that's not the result. What is the result? How many people used the coupon? When 35 jars were kept, nobody used the coupon. A small percentage used the coupon. Why? They didn't know which flavor to buy. 35 flavors are there. They didn't know how to decide. When there were only 4 flavors, a small percentage tasted, but a large percentage made a choice. Because they knew, they were very clear about what to buy. So what does choice theory tell us? Choice theory tells us that we are overcome by regret if there are too many choices and we made a wrong choice. So there are 200 shares to buy. People invest in bank deposit today because it seems like a default choice. Is that right? You can't go wrong, kind of a default choice. You are not covered with regret because nobody comes and stands in front of you and tells you that there is a market in which the same bank is earning 4% spread on your own money. Correct? But then the problem really is we are saying, oh, but that market has 100 things, no? I don't know which one to buy. The moment I buy, it starts falling after that. Correct? I don't know how to buy. Is that right? So therefore, it is important as savers and investors. It is very important for us to realize that there is a financial market, thriving financial market, fairly well regulated, which is available, into which money can be put in if these 3 things are democratic. The richest guys in the world are all equity investors. Huh? At one point of time, to be rich, you had to have an oil field in your backyard, or you should be born to a king. Today, you see the world's richest people, 8 out of 10 of them are equity investors. They have equity, only 1 share, which is their own company. Is that right? Highly concentrated equity portfolios, right? We are very astounded with the wealth of, the men in, the Infosys men in Bangalore, right? They all invested in 1 share which was there. So investing in a business is hugely lucrative. But the problem is that all of us cannot set up businesses, which is why we invest in. So when we say asset allocation or when we say investing, it is important for us to cross that step. What is that? Move from transaction, the convenience of doing a one-on-one at a fixed price. This price will not change. We ask that, no? Every time we have to invest, we ask how much return? What is the guarantee? No guarantee in life. We all decide to marry strangers after all. Can't we invest? We take so much of risk with our own selves. Right? My dad used to say, the way the coffee is placed on the table when I return from office is an indicator of how the evening will proceed. Correct? So therefore, it is very easy for us to see risks, isn't it? We are very aware of it. We can, good and bad quality, we can tell very easily. Is that right? Sometimes there are problems, but then in the market, there are so many others. We are company. So even if we are very adamant that Satyam is the best stock to buy and the price is going down every day, it means what? Nobody is buying. Everybody else is selling. You are the only one who is buying. So you have to have good enough reasons why you are doing what you are doing. Is that right? So without information, right? Without information, without risk management, which is what? Looking at because of information disclosure, you know the price, and because of risk management, which means what? You are able to recalibrate your position. That doesn't mean you have to recalibrate every day. Once a year is more than enough for most of us. Once a year, look at your portfolio and ask, am I holding good stocks, good bonds, and is my liquid money in the market? We are not. Right? So the question is of what percentage, right? So we want to say, what percentage of it. So these are all people they're all there in the market. There are governments, there are institutions, there are businesses, there are individuals, they're all there in the market, and those are the 3 markets. They can come in whatever fancy name. Oh, we are earning interest rate in the equity market and we are putting it in the debt market and giving you a tax-free return. Cut all that. Where is the money coming from? Correct? Where is the interest? Is this interest going to be sustainable? That's the question that you have to ask. So these are all that are there. As long as there is a market for lead, how will that market look like? Staid, simple, illiquid. Is that right? and small. So when they buy a house for us to live in, look at the real estate market. If it was completely driven by those who buy so that they can stay in it, what is the kind of property that will come in? Property that will relocate people who live on the streets, isn't it?